Good morning, everyone. Welcome to our Phillip Securities Research Morning Call. For today, we have results for JPMorgan, initiations for Disney as well as Reddit, a video on the ground on Toku, as well as an update on CNMC. For technical analysis, we have the usual S&P 500 as well as a summary of the trades initiated last week. As for macro and sector outlook, we have a summary of our US first quarter outlook, which was conducted last Thursday, as well as our Singapore weekly. This is our usual disclaimer. The information provided is solely for educational purposes and should not be considered as financial advice. Yes, so I'll hand over time to Glenn to get us started on the US strategy and stock picks. Thanks.
Yeah, thanks, Zane. Yeah, so we'll just start off first with the a quick recap on the first quarter 2026 strategy and stock pick that we had last week. Yeah, so for the we'll go first with the Singapore banks. Why we named this "Can the Goldilocks 2025 exit be sustained?" Why we call this a Goldilocks exit is because the banking sector avoided really the two biggest tail risks, which was a deep recession and also a resurgence of inflation. So after exiting this sort of perfect Goldilocks 2025, we believe that the banks now must navigate this quite narrow path to sustain momentum, which is why you see the banks actually on this tightrope walk into 2026. They mainly face two opposing dangers. If you look at the bottom here, there's the inflation spike, which represents that by the fire. Basically, a resurgence in inflation would force the rates to higher and then keep funding costs elevated and squeeze their margins. Whereas there's also the ice, which we call the recession dip, and a hard landing would freeze loans growth and also spike credit defaults and then test their asset quality buffers. Now, moving on to the next slide, we'll be looking at the fourth quarter results review. Most people and also the market actually feared net interest income and margin compression. But what we have seen in the first rate bar here is that the net interest income was quite healthy, and it sort of proved that the earnings trough is behind us. The fee income was very stable, and we saw that it's actually strong across the board. Whereas you look at investment banking income, it's a bit more volatile. So we see dips by JPMorgan and Bank of America. It came in quite flat. Now moving on to the next slide, we're looking at the how rate cuts are actually accretive and not dilutive for the banks. So there's this misconception that rate cuts hurt banks, but in this specific cycle, the cuts are actually bullish for net interest income, mainly because of the liability sensitivity of balance sheet. So as the Fed cuts the rates, the banks can slash interest on that they pay on deposits. So this helps to improve their funding costs almost immediately. But the interest that they earn on the long-term fixed rate assets, like the mortgages or securities, stays lower for longer. So the repricing lag, we believe, is finally ending. And we expect that margins will throw through in the first half of 2026, so it'll be quite flat. But this will actually expand afterwards as the yield curve steepens. Now moving on to the next slide, we'll be looking at the loans growth. So we believe that we are pivoting from this defensive balance sheet stance to a more offensive growth posture. And we are seeing actually loans growth continuing to pick up, and we are in this classic catch-up phase where loans growth, which is represented by an orange line, is trying to converge with the nominal GDP, which is represented by the blue line. Right. So we also think that the volumes now is moving more to a volume-driven instead of a rate-driven net interest income, and is often assigned a higher multiple by the market rather than typical rate-driven growth that we have seen actually when the rate hikes happened in post-COVID era. On the next slide, this is titled the Fortress Balance Sheet That's Mitigated Hard Landing Risk. So credit metrics have remained surprisingly strong despite fears of a recession, and the banks have effectively pre-provisioned for a downturn that hasn't materialized. It's very similar here in Singapore as well. You see the banks put on a lot of provisions. In the US, the sector has maintained a reserve coverage ratio of around 180%, which is significantly above the pandemic normal or average of around 140 to 150%. And this shows that they have a very big buffer against potential net charge-offs. We expect that the provisions expenses will flatten in 2026 or the rest of this year. And the best case scenario is that if a soft landing is achieved, we will see some of this excess provisions or excess reserves actually released in most likely in the second half of the year. And this will be a direct tailwind to earnings and earnings per share. However, in the worst case scenario is that if there is a recession or that the stability of this ratio on the high coverage ratio that we have will not be a drag on earnings. Now moving on to the next slide, we'll be looking at the credit card cap that Trump has been trying to propose or trying to get into trying to get approved. Right, and what we're seeing is that it actually has a massive disconnect between market realities and policy. So if they force the credit card use from their current 21%, which is what it is at now, and represented by this orange line, it will really destroy the spread that is required by the banks to cover their funding costs and charge-offs, and it will effectively make the unsecured credit card lending unprofitable. So that he's actually proposing to more than halve it, right, from around 20+% to 10%. And what will happen is that the banks will respond by slashing a lot of the credit limits, and this will shrink these blue bars here, which is showing the credit card balances, and also exit a lot of the near prime segments, and will cause a sharp contraction in credit availability. Now moving on to the next slide and the last slide for the banks, we expect that the ROE or return on earnings will stabilize at the peak levels that they have reached at now, around 12+% for the rest of the year. And a lot of the major banks are generating returns comfortably above their cost of equity, which is typically around 8 to 10%. And that this positive spread will be their primary driver. So, as the revenue continues to grow in 2026, mainly via loan volume and fee income, this positive operating leverage should defend these margins even if the asset yields compress slightly. Now moving on to the auto sector. So mainly it would be Tesla because they're in the Mag 7. So this is like Trump's laughing because he removed the EV tax credit, and then a Tesla salesperson unable to sell many cars. Moving next slide. Yeah, so what we expected, right? What I said in the last quarter's presentation was that the uptick that they saw in the third quarter was a bit of a one-off because of the removal of the EV tax credit. So a lot of customers rushed in to buy, and I predicted that in this quarter we'll actually see a decline, and it came true. So we saw deliveries for Tesla decline by 12% in the fourth quarter, and what we believe is that moving forward, this decline could continue for the rest of the year. Moving on to the next slide. Yeah, in China is not really much of a good story as well, right? So that's their second biggest market. In November, it picked up slightly, but if you look at year to date, November it's still in decline. It's actually down 8%. Whereas BYD, it's really the opposite, where we see their year to date November growth at 12%. So what's happening is that they're also losing market share in China. Now, the next slide, we're seeing the market share slides. Yeah, so market share is in a downward trend, right? We are seeing it decline across the board. It has a bit of up and down, right? So in September, third quarter at least, we saw the China market share pick up slightly, but I don't think this will be sustainable. It will probably decline further moving forward. And the US, I guess more importantly, because US is their biggest market, the market share has actually declined back down to 43%. Next slide, we'll be looking at the outlook, of 2026. So for 2026, the valuations for Tesla are record highs. It's PE of around 300 times, and it's really due to a lot of these non-auto related promises that the company and also their CEO Elon has promised them, which is like full self-driving, robo-taxi, Optimus robot. But a lot of these things are either very slow to come to market or they haven't even been proven. It's still a concept, right? It hasn't been proven at all. So the prices of the valuations of the car of Tesla is not based on them being a car company. And also the fall off from the EV tax credit has hurt them quite badly and will continue to be a long-term negative, and the decline in deliveries will sustain for the rest of the year. Yeah, and what they have done to combat it, which is by introducing their budget car, has not been the reception has not been good. So we have a sell call and a target price of $220 for Tesla. Yeah, next slide. So Ivan is on leave, so I'll be helping him to cover the semicon sector. Yeah, so but if you have any questions, please put it in our P3 app, and I'll get him to answer them. Now, next slide. And this basically shows the sovereign nations' demand, right, from the Europe, Americas, and APAC. So Asia has experienced quite a bit of a renewed growth, mainly from TSMC and memory players like Samsung and SK Hynix. Europe has returned to growth because of the higher demand from deals signed among the GPU players and sovereign nations. So Saudi Arabia, UAE are considered under Europe under this. That's why we see this uptick in the blue line. Moving on to the next slide, the memory inventory slide. Yeah, so the inventory levels of memory players like Micron, SK Hynix, and Samsung are at the lowest levels that we have seen since 2021. However, on the flip side, you're seeing that key customers such as Nvidia, Apple, and Intel are actually still increasing their capex. So there's a bit of a divergence, and which is why we believe that the memory chips are still in a shortage because the demand is outweighing the supply. Yeah, next slide. Yeah, so the memory companies are a bit in an upcycle, and why we say so is because Samsung's if you look here, Samsung's growth has finally reached flat at 0% in the second quarter, mainly because the chips were designed into their Nvidia's H20 chips through China, but because China blocked the H20 last year, they weren't able to actually let go of a lot of these H20 chips. And also there's a bit of a renewed growth because of shortage of memory chips. And the DRAM and HBM prices have spiked by more than 20%. Yeah, next slide. Yeah, sorry. Next slide, please. Thanks. So we base the memory companies on PB because earnings can fluctuate a lot, and on a lot of the memory companies, the earnings went into negative levels in 2023. So price to book is more of a I guess less volatile way of looking at it. The orange line here, as you see, is the +2 standard deviation. And we believe that Micron and SK Hynix are actually considered expensive because they are above the +2 standard deviation. But that for Samsung, we think that the valuations can still expand over the next 1 to 2 quarters because investors are pricing a premium because of the shortage of memory chips. Now going on to the Nvidia. Yeah, so currently US have approved the H200 sales to China, and then Nvidia was like rejoicing, but China then banned the H200 chips. So it's a bit of you ban it and I don't ban it, and the other way around. So historically, China has made up about 20% of Nvidia's revenue, and we believe that if China lifts the ban, right, and the H200 chips can be sold, it will represent around a 10 to 15% upside for earnings. Next slide, please. For AMD, it is still gaining market share from Intel. So revenue is not really an exact proxy to the CPU sales because AMD also has the GPU segment, and we expect that more deals will be won from AI companies, especially after the deal that they had with OpenAI. Really, we view it as an endorsement of AMD chips compared to Nvidia. So the higher demand will be expected for AMD's GPUs from the hyperscalers as well as from the sovereign nations. Yeah, so I think that's all we have for the semicon. Yeah, I'll now hand it over to Fahmi for the software and cloud sector. Thanks.
Hi everyone. Thank you, Glenn. So I'm covering for the software sector for the US market. So we are looking at the cloud players for the software industry, where the cloud players are taking the lead. While many of the software players are growing in a single digit, cloud players, on the other hand, as shown in the slide, Oracle, Google, Amazon, and Microsoft are accelerating, driven by the surging demand of the cloud capacity. Next slide, please. Next slide, please. All right, thank you. So the slide shows the comparison of the cloud players' revenue growth rates. We expect the cloud players' total growth rate of 27% year-over-year moving forward, and would be driven by the surging AI adoption. As more and more enterprises and people using artificial intelligence, it just means that the importance of the cloud as the operating layer to run AI is increasing as well. The largest cloud players remain Amazon, AWS, and Microsoft Azure. Despite their growth, despite their large size and their large revenue base, their growth are still accelerating. For example, we see Microsoft growth rate reaching the cloud player total growth as shown by the orange lines, reaching the light blue lines at 27% year-over-year. While the fastest growing cloud players are Google Cloud and Oracle OCI, with both growing at 34% and 74% year-over-year, respectively. Google is growing fast because of the tensor processing unit cheaper than the others, while the Oracle because of the large backlog. Next slide, please. Our next slide is on Microsoft, which we see the cloud revenue keeps accelerating as the growth driver. Microsoft remains the front runner amidst the current artificial intelligence theme. While many companies couldn't show material revenue from integrating artificial intelligence into their business, Microsoft could. We expect Microsoft Cloud Arm, Microsoft Azure to continue accelerating to 37% year-over-year, with AI contribution growth rate growing at 18% year-over-year. Mainly will be driven by the increase in its AI flagship product adoption, which is Microsoft Copilot. We maintain a cumulative call for Microsoft at $540. We think there's more upside for Microsoft, which would be driven by the Copilot adoption. We believe the adoption on Copilot is not only limited for enterprises, but also institutions and government, as you could read from the news and so on, especially with the sticky usage of Microsoft hardware and software in the industry. For example, when you purchase Microsoft Windows 11, most would come with the Microsoft Copilot, like automatically. That would help drive the Copilot adoption. Next slide, please. Next is on Oracle. For Oracle, growth is coming from their Oracle Cloud Infrastructure segment, as highlighted in the blue in the chart, dark red in the chart. The segment is becoming more important, with the percentage of the revenue increasing to 27% of the revenue by financial year 2026. Oracle have a diversified book orders beyond just OpenAI. Book orders now stand at $523 billion in the recent quarters, which is 10 times of the financial year 25 revenue last year. Although the majority of the orders are from OpenAI, which is $300 billion, but the remaining book orders are from the established enterprises, such the names like Meta, NVIDIA, XAI, and AMD. So while we also believe that Meta and NVIDIA is making up about 10% of the book orders at $68 billion. So we have an accumulate call. Sorry, we have a buy call for Oracle at $350. We like Oracle and still like Oracle for providing cloud for the niche regulated industry, where many of the other hyperscalers couldn't do that, most of them. And while it also the provider for the AI inference and AI training, which we believe there's more and there's a large total and addressable market for this market, which is still new and is a growing market, and more upside for Oracle by monetizing its large book order quicker, right? So I think that's it for Oracle, and that's it from me as well. Possible to the next presenter, Serena, for the digital ads. Thank you.
Hi, thanks, Fahmi. Good morning, everyone. I'll present for digital ad segment. So, the digital advertising story, we think that is now shifting from a phase of AI execution to revenue realization. We do believe that the industry is now entering a phase that when where all the companies will continue to spend on AI, but they will also focus more on how effectively they execute and monetize those investments. So moving forward, we think that it will be a very key for to differentiate themselves for their competitors. And as you can see in the photo, we do actually see that the user data has actually become a raw material of a modern digital advertising. So there will be likes, comments, views, and also interaction are kind of continuously being analyzed by AI system. All of this user behavior actually used to classify the user and also what's their intent in order to deliver more relevant advertising. In doing so, all the social media platform are actually be able to increase and able to turn engagement directly into revenue. Next slide, please. Thanks. So, as all the social media platform actually started to develop a deeper understanding of the user behavior, we do think that monetization will become more efficient. It should be expected, and we do think that the shift can be really visible in ARPU, which is average revenue per user. It highlights a very meaningful differences in monetization strength across all the platforms. So if you see the graph, the blue color line represent Reddit. It is a very good example of the improved monetization efficiency. Yes, the ARPU remains lower in the absolute term, but when it comes to growth rate, it is the fastest amongst the peer, around 40% compared to 2% and 5% of Snapchat and Pinterest. And this improvement is actually driven by one of it is better native ad format, and second one is the stronger community-based targeting, and the third one is that there is an incremental contribution for a data licensing agreement. And then if you look at the red color line, Meta remains the clear benchmark. The ARPU actually has rise to $15 by the third quarter. This is supported by a very deep engagement by the user and the increasingly very effective AI-driven targeting across the very huge scale user ecosystem. But in contrast, we do see Snapchat global ARPU actually reach around like $3 in the third quarter. This is growing around like 2% year-on-year basis. So that there is some ad format limitation and demand volatility. And as for Pinterest, currently the ARPU stands around like $1.78. It is being diluted a lot by the international user base because the ARPU for international users still very low at around 21 cents. But then overall, we do see that Meta actually sets the monetization ceiling, but then Reddit currently is catching up through the product-led improvement, but Snapchat and Pinterest moving forward, they might continue to face some structural challenges in scaling their global monetization. Next slide, please. Thanks. So, turning specifically to Meta, we do believe that the investor attention, I mean, over the past few months, has been a little bit too overly focusing on the rising CapEx. It kind of like overshadowing the strength of the core AI-driven advertising business. Yes, we do see there's an increase in AI-related spending, but we also do see that Meta continue to generate a very strong operating cash flow. We think that it highlights the resilience of the fundamentals, and the engagement across the family of app has also continued to grow since the AI investment ramped up, and also we do see the ad pricing has also trended higher. So we do think that it actually reflected a very improved conversion rate and also a stronger advertiser return. And then like I mentioned before, I mean, the free cash flow actually has moderated a little bit because of the high capital spending, but we do think that of this investment, front-loaded investment are actually deliberate. I think they are necessarily, and moving forward, we do think that there will be more meaningful monetization, especially from WhatsApp, because eventually we are expecting more adoption to click-to-message ads, and then business messaging will be once it becomes more mature, it will actually unlock a very sizable incremental revenue opportunity over time, and then it will be integrated and really indirectly benefits Meta, the entire whole ad business ecosystem. And Meta recently also focused a little bit on energy and infrastructure planning. We think that this is strategically necessarily because moving forward, there will be a lot of because all the data centers are very energy intensive, and power availability is becoming an issue for a lot of hyperscaler when it comes to AI deployment. So therefore that Meta has been actively securing the long-term power supply is either through renewable or even like nuclear link agreement. We think that yes, it will help it will add to the near-term capital expenditure, but they do actually support the long-term operational resilience. And this is why for Meta, we actually have accumulating with the target price of $770. And next slide, please. Thanks. So finally, turning to Alphabet, we also see a clear positive in the ability to sustain a strong dual revenue stream from both of the core advertising business and also a very fast growing cloud segment. So advertising across like search, YouTube, and Google network continue to generate a very stable and reliable cash flow. It kind of provide a very good financial foundation for the ongoing investment. But at the same time, that we do see that Google Cloud has becoming a increasingly more important growth driver. We think that the momentum is driven largely by the enterprise demand for their Gen AI portfolio. So around like 70% of the Google Cloud customers that actually sticks with Gemini-based product, and it actually helps Google's AI related cloud revenue to grow more than double year-over-year basis. And then it's not, Gemini currently is very deeply embedded across all the Google's cloud services. So it will help the offering in data analytical and also like enterprise workload. But beyond the enterprise, it goes back to the core business segment, which is search product. It has been integrated into the consumer product. So there will be AI power features such as like AI overview and AI mode. It's driving a very high queries volume and deeper engagement. We think that it actually helps Google to actually kind of like defense and also reinforce the advertising position, because the search behavior becoming more conversational, and it will be very useful for them to train the LLM for more ad targeting capability. And then looking ahead, there is also some announcement of partnership between Apple and Alphabet. They integrate, Apple moving forward, they will integrate Gemini into revamp the series. We think that short-term wise, the revenue impact might be modest, but we think longer term wise, it could become a very good opportunity, as given that Apple has a very massive install device base. It will be very useful when it comes to the data usage as well. So overall, Alphabet, there is one thing, resilient advertising core business, and the second one is that expanding cloud business, and also we do expect more AI partnership moving forward, and it will position Alphabet very well to monetize the AI across both enterprise and so consumer channel over the long-term basis. So this is why for Alphabet, we actually have a buy rating with a target price of $340. And that's all for me for digital ad. I'll pass the time to Helena. Thanks very much.
Thanks, Serena. I'll cover the last two sectors. So the first would be the e-commerce sector. So we're really in a period where consumer spending is no longer a growth tailwind, and at the same time, we're having a tariff and trade barriers. So all these are adding pressure to the sector. Moving on to the next slide. So this chart shows the U.S. retail sales growth year on year. So we can see that after the post-COVID rebound, spending has pretty much flattened out. Ever since 2023, growth has been largely in the low single digit. So their latest growth was 3.2%, which means it's barely keeping pace with inflation, which is 2.7%. So in real terms, this kind of tells us that consumers' purchasing power is stagnant. They are spending more dollars, but they're not buying materially more goods. So in practice, we are already seeing the tariff reshaping the behavior across the industry. Low-cost platforms like Shein and Temu, they're seeing double-digit drops in U.S. sales, and weekly weekly engagement after raising their price in order to cover the tariff costs. They're also trying to cut back sharply on their advertising spend in the US to preserve their margins. Some sellers, they have stopped direct shipment from China altogether, and a large share of brands, they have raised price to cover their higher import costs. So higher costs in a flat demand environment definitely hits margin directly, and the weaker players, they have very little room to absorb them. So this is where scale and strong logistics start to matter more and more. And next slide, please. So this kind of brings us to Amazon and why we like Amazon. Amazon, for starter, they're definitely not immune to tariff or things spending, but it's just structurally better positioned because of its scale and logistic networks, and also very diversified profit pool for them. So that allows it to absorb the cost pressure better than other players of smaller scale. Even within the chaos, their latest earning release still reports a revenue growth of 12% year-on-year for its retail sector. Amazon has also increasingly shifting its focus towards affordable essentials and daily necessities, and its logistics continue to improve. So same delivery is now more and more common, which means consumers can now purchase groceries and everyday essentials online instead of purchasing from physical store. So this helps to create an additional source of growth, especially when the overall demand is very flat and consumers are becoming increasingly price sensitive. On the other side, even though more than 80% of their revenue still comes from retail, Amazon is actually less dependent on retail now because their cloud business, AWS, actually has a much higher margin. My colleague Fahmi has already talked about the cloud sector, so I won't really go into the details. But overall, we're rather positive on Amazon. We have an accumulated rating with a target price of 290. Next slide, please. So moving on, I'll be talking about the smartphone industry. So smartphone are increasingly becoming the frontline device for AI adoption. We're entering the stage of smartphone AI war, where differentiation is no longer just about camera specs or design. It's more about on-device intelligence. So companies like Apple, Samsung, Huawei, everybody's trying to race to embed AI directly into the headset, from AI photography to real-time translation to personal assistant. And also another sign that we're seeing is AI is no longer just a software layer anymore. It's also driving hardware upgrades like more powerful chip, dedicated NPU, higher memory requirement, etc. Next slide, please. So if we take a look at the global market, growth is definitely showing some resilience instead of decreasing further, but it has clearly slowed down compared to earlier cycles, especially 3 or 4 years ago. But this slowdown, in our view, is not really a sign of weakness. It's just a sign that the smartphone market is maturing, because nowadays smartphones, they're more expensive, more capable, they're built to last longer. So consumers are holding on to their devices for more years. So the replacement cycle is extending, and the upgrades are increasingly driven by meaningful innovation instead of just necessity. So overall, we don't see it as a negative sign. It just kind of reflects a more rational and sustainable industry. Moving on to the next slide. So this is where really diving down to the market share globally. So we can tell that in the latest quarter, it's actually very obvious that Apple is gaining more market share significantly. So this is due to their latest iPhone 17 rollout doing much better than expected, because the entry-level iPhone 17 offers double the previous storage capacity, but was priced at the same price compared to iPhone 16, and plus with all the new improvement features. And the latest massive iPhone upgrade for Apple happened in 2021, which is more than 4 years ago. So we think it's kind of the right amount of time where people who purchase a phone back then will consider their phone old enough and will actually think about getting an upgrade. So this is why they have very good earnings in the last quarter, and also very positive outlook for the next quarter as well. Next slide, please. But even with them doing particularly well in iPhone, like I mentioned earlier, the smartphone war is now really the AI war. And if we really talk about AI, Apple is actually pretty late in the game, which is why we haven't really seen much growth coming from Apple in the past year. They did came up with Apple Intelligence more than a year ago, which sounded very promising, but most of the features they roll out did not really work so well, or it's just very minor changes compared to their competitors. So the most revolutionary change they have would be the Smart Siri update that got delayed and will roll out soon in early 2026. So I think Serena also mentioned earlier, they've recently announced that they're going to be collaborating with Gemini for their smart CV. So the smart CV will be built using Gemini. So that is, in my view, definitely a very positive news for them. Because if you really think about it, it's actually a very smart choice for Apple because they've been trying to develop their AI. They're already very late in the AI game. If they try to build everything themselves, like they did earlier, obviously it didn't work well, and it's going to cost a massive amount of investment, and it's going to take a very long time. So collaboration would be the most efficient way for them to close the AI capability gap very quickly. So they're taking on a role of a distributor instead of a developer, which is kind of smart from their opinion. And also, while they're taking the benefit of building up the gap, they're also retaining some of the control of the user experience and the ecosystem because Apple's core principle around AI is privacy first. Which is why even when they're built on Gemini, most of the processing will still run on device or using Apple's own cloud infrastructure. So that kind of set them out compared to their competitors, where everything is out in the open. They're stressing on privacy. But so far, Smart Siri hasn't rolled out yet. So we're definitely keeping a close watch. But right now, as for now, because we haven't seen much splash coming from it, so we still have a reduced recommendation with a target price at 230. So that kind of wraps up our US SSP recall. I'll pass my time to Glenn to talk about banking.
Yeah, so we'll be doing the JPMorgan, the fourth quarter results. Next slide. Yeah, so the adjusted fourth quarter PATMI rose by 9% year on year. It met our estimates, the FY25 earnings were at 101% of our forecast. So the main points were that the asset management income as well as the net interest income supported the earnings growth. However, the investment banking fees did disappoint quite a bit. Their net interest margins, declined by 7 basis points, and mainly. But then again, their net interest income grew from higher deposit balances as well as higher revolving balances in their card services. Dividend per share wise, it was up 20% year on year to $1.50. And more importantly, the dividend payout ratio rose to 32% compared to 26% a year ago. And the net common stock repurchases in the fourth quarter was at 7.9 billion. So some key highlights I did mention briefly earlier is that their net interest income has risen, also supported by the loans growth of 9%. And non-interest income has remained the primary growth driver, which is up 7% year on year, mainly from the principal transactions and asset management fees, which had the highest growth among all segments, up 17%. Investment banking fees were a disappointment, it's down 4%. Otherwise, we would have seen non-interest income actually coming in higher. In terms of their 2026 guidance, they have maintained their FY26 net interest income, excluding markets guidance of 95 billion. And they expect that the total FY26 net interest income to be around 103 billion. So the increase of the growth, right, would come from balance sheet growth and mix, as well as, but it will be offset by the lower rates. So their base case of 2 rate cuts in 2026. On the expenses side, they are expecting FY26 expense of around 105 billion. So this will be driven by the stronger revenue environment as well as continued investments into their technology and platform integration. Yeah, so we do maintain a neutral, but with a higher target price of $320 as we roll over our valuations. We do like JPM for their ability to continue growing revenue in all their segments, but we are quite cautious, despite them, giving quite good, strong numbers, mainly due to 2 headwinds. First is the macro uncertainties such as trade tensions and policy shifts, which would potentially increase provisions in NPLs. And the second one, and I guess the most important headwind we believe is that the higher expense growth. So the title of the report is, expenses to outpace net interest income growth in 2026. And based on their guidance, you can actually see that, that they're only expecting their net interest income to grow around 7%, but for expenses to grow by 10%. So there's a bit of a difference there. And the valuations for JPMorgan are also quite elevated. JPMorgan's P ratio is at 15x, which is higher than the 10-year average of 11 plus, and also PB at around 2.5 versus the 10-year average of 1.5 times. Yeah, so that's all for JP Morgan. I'll now hand it over to back to Helena for her Disney initiation.
Yeah, thank you, Glenn. So next we're going to be covering several initiations that we've done. So the first one was the Walt Disney Company. Next slide, please. So just a little bit background. I guess everybody is familiar with Disney. Next slide. Yeah. So Disney is a leading global entertainment company. They're headquartered in the United States. Currently, they have a market cap of around 201 billion US dollars. So Disney actually operates in a highly diversified business. So they have their business line spanning across so many different sectors. So the biggest sector they have will be the entertainment segment. So this is still their largest contributor. It accounts for about 45% of the total revenue. It includes film, television, and direct-to-customer streaming operations. The second biggest sector would be experiences. It's around 38% of the group revenue. So this is the theme parks, the resorts, the cruises, and also customer products like the merchandises from their franchise. The last would be the sports segment. It's around 19%. So Disney actually own, I think a lot of people don't know, they actually own the #1 sports streaming channel, the ESPN. So this segment is really the ESPN's affiliate fees, advertising, and subscription revenue. What we think really differentiates Disney from its peers is that it has a very globally recognized brand portfolio, and they're definitely #1 in their IP scale, because it includes franchises such as Disney, Pixar, Marvel, Star Wars, and ESPN. So all these allow the company to really monetize contents across multiple platforms and over a very long time horizon. Next slide, please. So we're going to briefly talk about the reasons that we like about Disney. So the first is the direct-to-customer segment is turning profitable. The direct-to-customer segment was actually their streaming segment, because nowadays it's a clear trend that consumers viewing, they're migrating away from linear television to streaming. So Disney, they're also trying to prioritize their streaming as the core distribution and monetization platform. So they've been doubling down on their investment for several years, and it has started to turn to profitability since the second half of 2024. So this turnaround is driven by strategic price increase and also their rollout and scaling of their ad-supported tiers. They're also having tighter content cost discipline and an improved bundling across multiple channels that they own, like Disney Plus, Hulu, and ESPN Plus. The second thing we really like about Disney, like I mentioned just now, they have yet the best IP portfolio in the world, the strongest and most monetizable. It uniquely combines multiple multi-decade franchise that appeals across different age groups and geographies. So this is very unique for them. And in 2024, they're also the best studio globally. They're also the largest contributor by market share. Their market share is around 21%. And what's unique about Disney is, unlike other studios, Disney is able to actually recycle their IP into streaming engagement, customer products, and park attractions. So this is really one of a kind for them. It's a compounding flywheel that they built. It's also the leader in the retail sales of licensed customer products. So we do believe Disney remains pretty well positioned in a very unique way. So they're able to sustain long-term value creation through the content-driven monetization across its entire ecosystem. Last but not least, next slide, please. There are also sports and experiences provide a very steady profitability for them. Experiences remain Disney's largest and most consistent operating income contributor. It occupies around 57%. It has a 5-year CAGR of 16%. So this is supported by their very strong pricing power and resilient attendance. But that means even when they increase the ticket for Disneyland, people are still willing to go because it's Disneyland. It's the best entertainment park in the world. And meanwhile, their sports segment, it's not really a growth segment. Its growth rate has actually been really flat, but it's able to generate very stable income, even during time when they're experiencing streaming losses or advertising downturns. Moving on to the next slide. So this is just to briefly discuss about the risks that they're facing. So economic conditions, the foreign currency, technical changes, consumer preference misalignment, where people no longer prefer to go to Disneyland, they're preferring others. This is unlikely to happen, but if it does happen, then there's nothing they can do. So it's also a pretty big risk. And operational risk, business strategy changes, and also competition. So this I won't be going into details. Next slide, please. So overall, we're initiating an accumulate recommendation with a target price of $130. So that's all from me. I pass to Serena to talk about Reddit.
Hi, thanks, Helena. Hi, everyone. So this week we also initiate Reddit. So for those who are not really familiar with the company, it is a forum-based social media platform which it operates a large scale online discussion. They focus on topic-specific communities known as subreddit. So the digital advertising actually accounted for around like 90% of Reddit revenue. So focusing on subreddit, this is actually a core of Reddit platform. They are actually topic specific community moderated by volunteers. If you look at the figures on the right, I mean the platforms, the first figure in the middle, they are kind of like the home feed page of Reddit, and then the next to it is the r/Reddit. This is how the subreddit works. Each community actually has a unique r/name. The content is actually created by the user. And the platform also provided I also highlighted it, a vote up and down function in order to boost the visibility. So subreddit actually serves as a content hub and also community building engine, so that it will provide a very highly targeted audience that actually drives Reddit's revenue relevance and also first party data value. Next slide, please. Thanks. So another revenue stream for Reddit is actually data licensings and others, which account for like around 10% of the total revenue. So the data licensing deals actually focusing on two main uses. The first one is for LLM training. So currently Google's and OpenAI are actually Reddit's most prominent disclosed partner, and they actually estimated around like the majority accounted for the majority of the $203 million contract value as extending through 2026. And then these, like I say, this contract actually multi-year arrangement, and then it's expected to have an annual value of around like 60 million for Google and 70 million for OpenAI. And the second user's purpose of it is to have a data API access. This is mainly by most of the financial institution to have a real-time data access. And then there is also a very small revenue contribution coming from Reddit premium subscription. So for our investment thesis, the first one, we actually think that Reddit has a very differentiated and sticky user behavior, which helps to create a very durable ad opportunity, because the community-driven platform, like I mentioned, it offers a very strong first-party data advantage. So subreddit categorize all the users' interests and also intents, so that they actually will be less likely to rely on compute intense ad targeting. So and then at the same time it helps with more relevant advertising because they already do the categorization. So this is why Reddit is also still remain a very capex-like company, which is around like less than 1% of the total revenue. And recently they have actually launched an AI-driven tool. It's called Max Campaign. It's actually an AI-powered automated ad suite. So for advertiser, it will help to reduce the cost per acquisition because the system could actually adjust the ad placement and bid in a real-time basis. So we do think that this effort could actually support a very scalable advertising model, with also expected to have a ARPU growth and long-term monetization potential. And leading to the second investment thesis, because of the very strong party data advantage, we do think that it will provide an upside to data licensing potential in the future. So far that there is an existing deal, like I mentioned, over like 200 $200 million with both Google and OpenAI, most of it extending through 2026, and they are currently having a further discussion around like deeper Gen AI integration. We also think that there is an upside. Is also overall industry demand is accelerating, so the AI data set and licensing market is actually projected to grow around like 26% through 2030. So we do think that moving forward, Reddit will actually continue to enhance the value of the data sets because they also started the initiative like the Reddit answer and also multilingual expansion. Yeah, next slide, please. Yeah, thanks. So when it comes to the risk, we do see that the heavily reliance on advertising is considered as one risk because it generates 90% of the total revenue. That's why it makes it very sensitive when it comes to ad spending and also overall macroeconomy cycle. And then even though we think that this concentration actually creates some of the risks, eventually if advertiser decided to reduce the budget and move to another social media platform. But we do think that so far, the unique community-driven targeting and also the first-party data actually offer an opportunity for Reddit to capture the premium ad dollar and differentiate itself from the competitors. And the second one is that they are highly rely on very highly engaged user because this is how that they build the community and also build the content in order to have the data, the very valuable data. So when it comes to a slower user growth and engagement risk, we consider it's part of the risk because once the user actually reduce the time on platform and for example, like slower international adoption could also limit the monetization. But so far that we do believe that we do see the strong engagement from the user, especially they actually categorize it between lock-in and lock-out user. And lock-in user is still having a very strong engagement on the platform. And moving forward, since they are expanding on the multilingual and we do think that it will provide an upside for increased ad impression and also a deeper monetization of Reddit unique audiences. And the third one is that we do see the moderator power as a risk because the platform relies a very large network of volunteer moderators in order to maintain the content quality and also enforce the subreddit rules. So that, I mean, even though that this model actually helps Reddit to scale maybe in a relatively low cost, but it do carry a certain level of operational risk because moderator might actually interrupt the rules interpret the rules differently, or also they might actually disagree with the company policy. Yeah. So for Reddit, we actually have a buy rating. We think that there's a terminal growth rate of 6% and the target price of $280. Compared to the current price, is actually around like more than 20% upside. So this is why we have a buy recommendation. Thanks. So next slide, please. Thanks. So next, I'll present Phillip on the ground for Toku Limited's IPO. So for those who are not familiar with the company, it is actually an AI-powered cloud communication provider. They specialize in customers' experience solution for enterprises in Asia Pacific. So for service basis, they actually offer a very integrated suite, spanning for example, like programmable voice, messaging, and also contact center services. This is all powered by the AI-driven analytics. So for the IPO, the company actually now offering around like 65 million unit of share, and they announced an offer price of 25 cents. The market cap is expected to be around like 143 millions, and the proceed will be used to focus on the AI power 360 platform. And secondly, around like 28% of it will be seeking potential strategic acquisition. But then when it comes to the dividend policy, Toku does not really pay any dividend at the moment. Yeah. So the, 。  wait, sorry. 。  。  。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 。 Yeah, so they don't have a dividend policy at the moment because the management they actually want to prioritize geographically expansion and also platform expansion. Yeah. And then next slide, please. Thanks. So if you look at the graph on the top left, you can see that the usage-based revenue actually remains the largest contributor for the company. It's around like 62% for the financial year 24 revenue. This is driven by voice, messaging, and also data traffic. So from a financial perspective, Toku actually achieved around like 47% revenue growth rate between 2020 to 2024. And at the same time that they actually do manage to, I mean, they actually managed to improve their gross margin by 6.7% percentage point. And then at the moment, this company remain loss making, but the losses actually narrow significantly in the first half of 2025. It is down nearly 67% year on year. So that if you're interested about the IPO, the application actually already started on 14th of January, and it will be closed on tomorrow's 2 p.m. And the volume, I mean, the unit basis, there is a minimum of 1,000 unit basis requirement, and subsequently plus 100 unit basis. And for these particular shares, the indicative trading day will be on 22nd of January at 9 p.m. Oh, sorry, 9 a.m. So I think that's all from me. I will pass the time to Hashim for CNMC. Thanks very much.
Thanks, Serena. I'll be going through a CNMC update. Next slide. Okay, so for CNMC, their 60% expansion of their carbon in leach plant is doing well. So their throughput has increased from 500 tons to 800 tons per day, and now they're running at full capacity. So what's impressive about this is their dual circuit system. So this means they can keep processing gold even during maintenance or unexpected shutdowns. So essentially removing the costly production interruption. They're also seeing improved gold recovery rates from this expanded facility because carbon in leach has a higher recovery rate than flotation. And this upgrade has been translating to higher production volumes for them. Next, the company is building an additional underground mining facility, as we know. The capex is relatively modest, about 15 to 20 million ringgit, which is roughly about $4 to $6 million. So it was scheduled for 2025 completion. Now it's pushed to first half of 2026. And the reason for that is the water accumulation issues. It's located in the rainforest terrain of Kelantan, which is prone to water accumulation issues. And our view is that it may be further delayed. It could even be delayed to second half of 2026, and the operations may start from 2027. So we see this as a natural progression after a decade of open pit mining. So underground mining costs more, extraction and mining costs are higher, but the ore grades are also better. So you're getting more gold per ton as compared to your open pit mining. So lastly, for shareholder returns, it seems that management is willing to increase shareholder returns if their financial results are exceeding expectations. So you can see this chart. In 2020, they did not pay any dividends, but in 2021 and 2022, their dividends per share exceeded their earnings per share. And you can see their dividend payout history was in the hundreds. And it has been on a consistent trend of like 40 to 50% range for their dividend payout. And this is higher than their payout ratio target of 30%. So they also have a $37.3 million net cash as of first half 2025, and we think they are in a good position to increase their shareholder returns. So key catalyst to watch will be the earlier than expected completion of their so-called underground facility and a higher dividend payout ratio above the current 30% target they have. So we have a buy rating with a higher target price of $1.47. I'll pass on to the next speaker.
Thanks, Hashim. I'll move on to the technicals. Okay, so for the S&P 500, it's currently trading a bit sideways. Last week was down slightly, about 0.38%. So as of Friday's close, it remained above the 6,920 breakout level. I think this week wise, we're likely to see some sort of a continuous sideways consolidation ahead. Currently the S&P 500 futures are down about 0.8%. And then as of current resistance likely to be at the 6,980 level, which is a horizontal resistance currently, and then above that likely to be at 7,030, which is around the upper Bollinger Band. And for current support, it's likely to be at 6,885, which was the swing low on Wednesday last week, and then to 6,920. And then this slide is on the summary of the technical calls initiated last week. So first one, for the buy call for Oracle, it hit our stop loss, so it's down around 6.19%. For the sell for Meta is currently in progress, up about 1.7%. For the buy call for Alphabet is currently down 1.7%. And for the buy for CoreWeave is currently up about 8.6%. So that's all from me. I'll hand over time to Paul for the Singapore Weekly. Thanks.
Thanks, Zin. Next slide. Yeah, there's some key macro highlights from last week. So most of the data for Singapore, the data is generally still healthy. For exports, we're still growing about 6%. And the only reason it slowed down because pharmaceutical, the prior month had a huge 370% spike. In terms of SIA data that came out last week, was largely a mix. I think passenger data actually could be very weak for SIA. You're looking at 1% growth. This is the weakest passenger growth since the pandemic happened. Yeah, so then for SIA cargo, we'll be getting a rebound. So probably this is going to be positive for sets. And US retail, US data that came out is generally in line, or generally the growth is stable. You look at retail sales, it's still growing about 4%, like strongest in 4 months, and loans is also strong. So we are getting the releveraging into the US economy, and core CPI is also holding steady. So in general, the US data is benign. It's kind of we highlighted our base case for 2026. Next slide. Yeah, move on to some of the tactical views. So in terms of tactical views, we issue our weekly strategy in our morning note. So what we've seen is, we call this the affordability crusade by Donald Trump. So the prior week he's imposed credit card caps, like what Glenn mentioned, on terms of interest rate. He's also banned funds from owning family homes in the US, and he's also looking to buy mortgage bonds to try and suppress interest rates. So every week he's making some so last week he announced that technology firms, namely the hyperscalers, the Mac 7 companies, have to take on their own infrastructure and not rely on the government. So basically, the Mac 7 have to become an off-taker. If they can't, then they have to build a power plant on site on the data centers. He's also announced some healthcare plan. I won't go through in details, but the direction is clear that he continues to a lot of populist measure by Donald Trump. We view this as negative for the US market because all this is very disruptive for all the various sectors, like we have already seen for the banks. One beneficiary from this would be CSE Global, SGX company, because they provide power supply solutions for all the data centers, basically the huge container-like switchboards that's on site in the data centers for all the power plants or data centers, sorry. So what they're trying to do now is that this might cause the hyperscalers to accelerate the power plants and not rely on the government. So this will benefit CSE Global. The big tech news last week was TSMC results, the wafer fab. So the two critical takeaways is the capex. So they're going to lift up their capex by 30% to 54 billion, and they want to build forward the construction of their existing fabs. So this is important because TSMC is usually very conservative. So what they highlighted is that they're not going to take a 50 billion risk on capex per year unless they have to be sure of the AI demand. And they also mentioned that the capex is going to be higher, not just for 2026, it's going to be higher for the next 3 years. So one beneficiary of this is going to be ASML, the lithography, because most of this capex is going to be for advanced process. So the big winner from this is going to be Franken, because Franken's biggest customer for semiconductor is ASML. We also think Franken growth can actually even outpace ASML for two reasons. Because ASML wants to outsource more of their production out from Europe into Asia. So Franken, with their Asian manufacturing base, will benefit. And the second thing is that Franken is actually doing their next generation, the highest end product for ASML, which is the EXE machines. I won't go through to this, but this is the most expensive, like $300-400 million per machine. So that's why we think Franken will ride from this jump in ASML's capex. Just to be clear, no, so Franken's customer is ASML that build the machines, and TSMC buys all their machines, the high-end machines, all from ASML, which is the lithography part at least. The second key takeaway from TSMC's results has been their comment on AI spending. So what it implies is that AI spending will not peak. So they actually raised their guidance for AI revenue, the compounded revenue growth they think from AI related chips and so forth will go to from 50% to mid to high 50% growth up to 2029. And just to reiterate, all these capex that they're spending this year, you only see it is actually, by the time you build a fab, you put the equipment, you only see the supply coming in 2028, 2029. Sorry, it's 29, not 20. So it means that they are pretty confident that the demand is going to be strong even to 2028, 2029. So I think the market just took this as messaging that spending on AI has not peaked. I'll move on to what to expect for the weeks ahead. So for weeks ahead, we will have Netflix results. Donald Trump's going to have some speech in Davos, so not sure what he's going to say. Then, of course, we have Intel results. So these are things. In terms of our corporate insights webinar open to everyone, we will have the Assembly Place, which is the new IPO coming up. So they will do a presentation with us, and then OUE read and Prime read. But all those are in February. Next slide. Yeah, next slide. Yeah, okay. So this is just some illustration of charts. I won't run through, but the one on the right is pretty evident. I didn't put this up to 2023, but because there's a big rebound. So if you push it down, passenger growth is actually very weak for SIA, the weakest until the pandemic. Of course, the pandemic there were no flights, so of course there's zero passengers. But you can say this is the weakest growth since the last 4 to 5 years. Next year. Next slide. Then the next is nothing much. This is just to show that in general, economic activity in the US is generally stable. So retail sales is stable, and then loans growth is picking up. So this is going to leverage up the economy, which will stimulate growth in the US. Next slide. Then this is just inflation. So inflation in January is stable. If you look, what is happening for inflation is that energy is the one that is coming down. All prices. I think gasoline prices in the US is multi-year lows. So you look at the gray line here, and the other thing that is holding up is the green line here on the left, which is goods. Sorry, it's a bit hard to see, but generally goods and energy is holding down inflation, and then services is all trending down because of the weaker job market. Then on the right here is just the trend line for CPI, which is generally just moving sideways. So there's nothing alarming coming up from inflation right now to make us worry and cause the Fed to maybe hold back on any interest rate cuts. So I think that's it for me. I think we can move on to Q&A.
Okay, I guess I'll start first. The first question is what to expect from Netflix results this week. So I think there wouldn't be much surprises. We're definitely going to see very solid year-on-year growth in both revenue and earnings, like they have been delivering over the past few years, because right now they're still the clear leader in the streaming industry. In terms of subscriber wise, they have almost twice as much as compared to their closest competitor, which is Disney, and they monetize it way better. And they're seeing very strong international additions and pricing traction. And also it's the holiday season, so that's usually where they perform the best. So I guess no surprises there. So the real focus on the earnings would be more focused on their commentaries in terms of their strategics and also the guidance. So strategic wise, it will be focused more on the growth in their advertisement business. So that is the business that's becoming a more important narrative for their long-term growth story. And the other would be their commentary on their Warner Brothers deal. Especially after the recent sell-off. So the recent sell-off, it's mainly due to the deal concerns because of the high cost and the increased debt, and also consolidation of two very big companies. It won't really be easy. So it will really depends on how the narrative comes through. That will have a bigger impact on how the market reacts. So just my 2 cents on how I look at the deal. I think if the deal were to go through, they would definitely enter the IP ownership race. It won't be the number one that owns the most IP. Disney will still be the one that has the strongest IP. But Disney's focus is a little bit different, like I shared earlier. They're focusing more on their IP flywheel, integrated into theme parks and merchandise. But Netflix would definitely become the most powerful screen-based IP owner. And this is going to reward them in terms of upside from the higher ARPU. They're going to be able to monetize their advertising better, and they have improved content leverage driven by the new HBO and Warner Brother franchise. But the bad side would be the higher cost increased debt. So yeah. So I guess this is going to be the focus of the earnings this week. And another one I saw was about Apple because last quarter their price and earnings were actually good, and that contradicts with Poem's selling recommendation. Will it happen again? So I actually briefly talked about Apple in my sharing earlier. So the reason we have a sell recommendation was the quarter they are doing good, but Apple as a general, their growth has been really flat compared to their other peers of the Magnificent Seven, who's all been having constant double-digit growth. Apple's growth is very, very low digit, and this doesn't really justify if you have a PE ratio of 30 plus X. And they're really late in the AI race. So even though their latest quarter was doing good, it's because their iPhone 17 was doing much better than expected, but there's no revolutionary AI changes. But like I mentioned earlier, because of their recent announcement of the collaboration with Gemini, so that is definitely a positive for Apple. But they haven't really rolled it out yet, so we're still keeping close. We're still monitoring it closely. I guess we're going to be having a better understanding because they're releasing their earnings by the end of January. So we'll see by then. I hope that answers your question. I guess that's all from me. I'll pass the time to my colleague first. Thank you.
Yeah. Let me just take some of the questions first. Let me just. Yeah, one's asking about Yangtze Maritime. How about their fundamentals? Are they good? And also that their company announced a share buyback. Yeah, so it's quite interesting that they announced a share buyback, so soon after they listed, right? It could be a signal, that they believe that the current share price actually is undervalues the company's assets. So that's why they have this. They are okay with buying back shares. I mean, that could be one of the reasons. But for Yangtze Maritime, we don't believe that it's a very stable growth kind of company. Yeah, typically they are a financial holding company. So what they do have is that they have a huge, I think it's around, I can't remember the exact amount, but they have a huge, I think it's 1 or 2 billion that is still stuck in like fixed deposits or treasuries, so earning a very low percentage. I think it's like 2 or 3% kind of interest. So what the aim for them, is to move that out into to use that money. So that would be the huge upside for Yangtze Maritime. Yeah, so it's I would say it's very stable growth, not a high growth kind of company. That's what. Sorry, let me find where are my rest of my questions. Yeah, okay. I think there's a few on the banks. Yeah, someone asked why OCBC can check why retreat last week after hitting $20.50. Yeah, it didn't really retreat. I would say it's now at $20 and 35 cents. Yeah, so I don't think there's much of a retreat. Maybe a bit of stabilization. Yeah, not a retreat per se. Yeah, so it's still quite strong. OCBC share price. It's still, I think it's at all-time, just below the all-time high. Maybe a bit of profit taking as well. Yeah. I think there's one more on the US banks. Yeah, should we avoid JPMorgan as Trump has threatened to sue it? Yeah, no, I don't think so. I think this lawsuit is really a bit of noise, right? So, nothing much of if he threatened to sue everything and the share prices tank, then yeah, that wouldn't be the right move, I guess. So it's more on the fundamentals of the company. And I think what's more important for JP Morgan and also the other banks would be the credit card cap, which I spoke on about earlier, right? And how that if that really happens, how the banks would just would change. We believe that the hit to earnings is around 10 to 15%, if that really comes true. But the banks would find a way to lower their loans, their balances, credit card balances, loan balances, and also remove a lot of those rewards or fee waivers that they are currently giving in order to balance it out so that they can get profitable returns from actually running a credit card business. But we anticipate that the hit to their earnings could be to at least to their credit card earnings would be around 10 to 15%. Yeah, I think there's one more. Yeah, someone's asked about US banks. I did, speak in quite at length earlier at the start, but just to reiterate, we believe that rate cuts are beneficial for the US banks, particularly because their cost of funding is going down much faster than the asset use, and also that they are very well provisioned. Coverage ratios are at record levels, 180% compared to pre-pandemic levels of 140, 150%. So in the worst case scenario, if the situation doesn't improve, they are still maintaining high reserve coverage. So we don't believe that provisions will expand that much faster. And in the best case scenario is that if there's a soft landing and the situation improves, then they can release a lot of these reserves, and this will flow straight down to their bottom line and improve their EPS. Oh yeah, there's one here on Skylink. So is Skylink risky? Car rental like Chariot in trouble? Yeah, so Skylink is they are not a car rent. They are sort of a car rental company, but they actually do a lot of the commercial vehicles, right? And they do a lot of leasing. So unlike Chariot is a car rental, right? So think of like I can't remember the name, but like the ones that you see at the those void decks or HDBs, you see those cars, Get Go, if I'm not wrong. Yeah, those kind of cars where you can just rent the car and then you put it there and then you rent like per hour or per day kind of basis. So their business models are very different. And Skylink's business model is they don't really want to concentrate on the consumer, so they're doing more commercial, and also their leases run much longer. It's not 1 hour or 1 day or even 1 month, right? It's 6 months to a year kind of lease. So it's a lot longer term, a lot easier to lock in that customer. And they also offer a lot more add-ons, right? So they do MRO as well. They do financing. So yeah, I think the Skylink is a completely different company if you want to compare it to Chariot. Yeah, Chariot is like the Get Go or the Blue SG equivalent. Yeah. So I don't think it's risky in that sense, like if you're comparing it to Chariot being in trouble. Let me see any more. Yeah, why is the UOB share still so strong? I wouldn't say it's strong. I mean, it has dipped tremendously and then it just recovered slightly. But if you look at 1 year kind of time frame, right, is actually underperformed the other two banks quite drastically. They're actually down. If you look at 1 year, so 2025 wise, is down like by one odd percent. Whereas you look at like DBS, it's up 35%, and then even OCBC it's up around like 19%. Yeah, so I don't think it's strong. It just has stabilized a bit, right? Yeah, but their performance has been very poor compared to their peers, their direct competitor peers, which is OCBC and DBS. Yeah. Yeah. So, and I mean the main reason, of course, it's their provisioning is very high, and also their dividend policy and dividend capital return plans have not been well known. Not well known. They haven't even announced anything yet. Yeah. So if someone asks about Genting, I think Paul will be able to answer that. Yeah, okay, I think that's all for me. Let me hand it over to the rest of my colleagues. Thanks.
I think I will answer some of the questions about Meta and Reddit. So the first question is, why did Meta share price underperform despite cutting costs in Reality Lab? I think for Meta story, the concern really currently they still lies on the capex and also an acquisition. And yes, they do announced that they reduce 30% of the budget on the metaverse, but this business segment has been losing money quite a while. But to be honest, on the long-term basis, we actually think that this decision is positive because moving forward, I think it is a good idea for them to focus on their the resources in order to boost the core operation, which is advertising. So this is why they I think I also view it very positively that why they acquire Scale AI, which will be very helpful to train their LLM, which is Llama, and currently it's a bit behind the competition compared to Gemini and also OpenAI. And also they also announced the acquisition of Mainers. I think eventually, currently it's not, but eventually if it can power by a Llama to become an AI agent, I think it will be very helpful to reach their goal in kind of like automate the ad business for the advertiser. But I think on the short term basis, they still, I mean, for the investor, they still have some of the concerns about the capex. So I think moving forward, I mean, especially even in this particular upcoming earnings result, do expect some of the clarification on what is the roadmap on that. But so far that all the investment that they announce it, I consider it really quite positively because I can see that how you can fit in their business strategy. And then the second one is that for Google Cloud, Google started from a very low base in the cloud space compared to AWS and Microsoft. What's the market share and growth in the cloud market share for this hyperscaler? So, I mean, for the growth itself, for when it comes to between these three cloud providers, Google Cloud actually has the highest growth percentage. It's around like 34%. But then Microsoft and AWS, they consider the scale of it, they still have a pretty strong revenue growth. So Microsoft is around like 26%, AWS is around like 17%. But then market share wise, I mean, it fluctuates a little bit, but currently AWS is still holding the largest market share around like 30%, while I think cloud fluctuate between like 12 to 13%. Yeah. And then there's a questions about Zixing. Is the sales of Zixing share by substantial shareholder Cool Thomas Clive a cause for concern? He sold quite a lot of shares. At the moment, I don't think his decision of selling the share is considered as a risk to the share, because one of the reasons is because he's not exactly existing the entire stake. That's the first reason. And the secondly is that even selling the substantial amount, he still remain quite a substantial shareholder for Zixing. I mean, before that, I think it was around like 14% of the holding. Now it's still more than 10%. So at the moment, I don't think so. Yeah. So there are two questions about Reddit. I think I can answer it all together. So, hi Serena, what's the competitive resilience slash moat of Reddit business model? And another thing is that, I find it hard to understand how Reddit can make money through advertising, and I hardly see ads when I visit Reddit page. Am I missing out something? I think like I mentioned in the presentation, the first one, the competitive resilience, really the first party data advantage. I mean, this one, instead of they have to buy the data, the user data from other company, the platform actually runs itself. And then another thing is that how it works. Reddit itself, like I mentioned it before, they are community based, means that everyone will actually join a community based on the interest, means that you don't really have to filter out the user and they categorize it in order to perform that ad targeting capability. The first step of user engagement already helps you to it. That's why you don't really need a very high LLM. You don't really have to train a very good LLM in order to categorize it, so that I think for example, like if someone is really into sports and all, and then because they join the community that related to a sports, for example like golf, and then the advertiser can actually target it through it. So that I think that's one of the competitive advantage for Reddit compared to other social media platform, because Meta, for example like Meta, they have a very big user, but then they still need to have trained an LLM to understand that what's the user behavior and also preferences in order to categorize it, what to shows them. Reddit, the first part of it, the whole platform kind of have a base for it. And the second thing is that because of all of this, they not only can use it for their own advertisers in order to gain like advertising revenue, they can actually sell it and have a partnership deal with other company that requires a certain level of LLM training, like Alphabet and also OpenAI. So this is why it creates the second revenue stream for the Reddit, even though it's not big, but at the moment it has an increasing demand for it. And especially for the deal with Alphabet, because there is a deal, Reddit is also the most sorted and also the most referenced website on Google search as well. It will directly link back to Reddit platform, which will help with login and logout user, and then which will actually boost the engagement, and then eventually will boost the ARPU. Yeah, I hope that answered the questions. Oh, and then there's a what are the reasons for Toku loss making? I mean they considering they're still how do I say? I mean they're still trying to expand their businesses. I mean the losses actually widen because they spend quite heavily on the building out their customer experience platform, so that they actually spend a lot on their R&D and also technology. But at the same time, that because they currently quite focus on Asia Pacific, but moving forward, I think they want to have a global market expansion. So they kind of spend money on that as well. So this is why their investment why is that leads to a loss making. Yeah, I hope to answer the questions. I think that's all. I'll pass the time to my other colleague if there's any questions left. Thanks very much.
All right, thank you, Serena. So let me take some few questions quickly. Hi, for Google Cloud, I think this already been answered by Serena, but I just put some additional information, I guess, because I presented this slide earlier. So hi, for Google Cloud, Google started with low base in the Google Cloud space compared to AWS and Microsoft. What is the market share versus the growth in the cloud market share for this hyperscaler, please? Thank you. So earlier we said that Amazon is the largest of the hyperscalers. They are making 44% of the revenue, Microsoft Azure at 32%, Google Cloud at 19%, and Oracle is the smallest at 5% of the market share. The growth, well, in the same period, naturally, hyperscalers with a larger market share would have slower growth because they already have the larger market share. Amazon at 18%. Amazon is growing at 18% year-over-year. Azure at 16% year-over-year. Google Cloud at 31% year-over-year, and Oracle is surging because it's half the smallest market share. It's growing at 56% year-over-year. Yes, so that's the number. So for the next question, why is Microsoft underperforming? Did the Apple Gemini deal weigh on the share price? You are mostly correct. I think that the recent share price declines likely might be because of the Apple Gemini deal. I think announced back on 12th January. But it's not only Microsoft though, that other hyperscalers like Amazon, I think the price trend slightly lower. When if you look at the deal is only amounted to $1 billion US. It's small in comparison to the large cloud market share, and also small in comparison to the revenue generated by Microsoft and Amazon. So we think that this is just some short-term market worries. So we don't see any changes that's concerning in Microsoft fundamental. Also in the recent quarter, as for our slide, Microsoft Azure cloud growth is still expected to accelerate, and Microsoft itself is backed by the leading AI operator OpenAI and have sufficient backlog. And Microsoft Azure AI is not behind Google Cloud, at least as they are backed by OpenAI. That's what we think. So last question is that, hi Fahmi, what's your take on the lawsuit filed by Oracle bondholders last week? So bondholders filed a lawsuit that alleging Oracle misled the investors when it sold about $18 billion US in bond in September of 2025 by failing to disclose that in the next few weeks they already plan to raise another $38 billion US in debt, and which is all of this to fund the AI-related data center build-outs tied to the OpenAI deal. So the bondholder claimed that they suffered paper loss from the increasing in the Oracle debt as the bond value fell. Bond value fell when the default risk increased because the amount of debt for Oracle increased as well. So we don't know how long this lawsuit would take, and it's not mentioned potentially how much it's going to cost the company. But we think this wouldn't affect Oracle, at least in the near term, if that's what you are worried about. It is less likely to affect the day-to-day operation of Oracle. I think lawsuit normally take years to complete, and to even reach settlement would take years, which by that time Oracle should already realize most of their book orders and increase in revenue accelerate. So Oracle is currently not legally required to make up for the bond value loss unless the court dictate them to do so or through the settlement, which I think is not in any time soon. Yeah, so I think this bondholders lawsuit is not something to worry, at least in the near term. Yeah. So I think that is all from me. I'll pass over to my colleague if there is any question left for me. Thank you.
I'll answer two questions. First question is, how's the tax issue developing for CNMC? Do you foresee bigger on this front? So for context, for those who aren't aware, CNMC share prices fell about single digits after they received income tax assessment for about $7 million from the period 2019 to 2024. The reason for this additional income tax is because previously the company deducted management fees paid from the subsidiary to the company, to the parent company. But the Malaysian Income Tax Authority stated that that's not tax deductible and they have to pay the taxes. Progress-wise, the CNMC is still in the process. We don't want to share anything that is still ongoing. But our view is that there may be a settlement, and in the end, it's not going to affect their core operations. And for that reason, we are still bullish on the company, and we think it's not an issue that will hurt their current operations. Second question is on SIA. So can you give your view on SIA's latest commercial operation with Air India? Will there be downside risk? So for this, the commercial operation is focused on code share agreement mainly. You do have code share agreement, coordinated flight schedules, seamless booking across both Air India and SIA's websites. So the way we see it, SIA already has a stake in Air India. They really want a pie of the Indian aviation market. So this is just the next step towards them getting that pie of that Indian market. They are deepening their ties and downside risk wise, we think it's too early to say, but if we do have to point something out, perhaps regulatory approval uncertainty. For this kind of joint agreements, we don't know if there will be support from the aviation authority. And second, execution risk, because Air India is still in its expansion phase. They have ordered hundreds of airlines, and this commercial cooperation will depend on how fast Air India can get up to speed. And we think these are things to look out for, but risk-wise, it's too early to say. I think that's all, and I'll pass on to the next.
Hi, so I have one more question that I could answer. So, can you talk on Adobe? Why is the price consistently falling sharply? So, what are the issues, and can't face off the comps? What are your recommendations now? So, for Adobe as a company, it's not failing, but it's like the growth expectation and the AI positioning. I think it's a bit of under scrutiny by the market. That is more like valuation and from the market. Is that First is because of the AI monetization, and second is because of the intensifying competition from the market. Those two things. First is on the AI monetization that, Adobe announced that AI usage in their product as most of the other company, but currently AI monetization is only making about 1% of their company's revenue. So market is not looking at that and not so happy about it because they think that, hey, the other companies could do better than you. Why you just making 1%? I think that is only about it. But then again, if you look at the company closely, this AI revenue or part of the revenue is growing double year over year, but it's small in comparison in amount, but it did grow. And we think that in financial year 2025, that the sentiment of this would improve maybe slightly compared to last year, right? At least the pressure from AI into the companies is slowing down now, not so much. So yes, it's not looking good, I guess, there from the market view. And then the other one is the rising competition. You got the other creative software companies that cater to the lower end of creative retail customers like Canva, Figma, right? Although Adobe provide like holistic product, like they provide for the upper end of the customers and lower end of the customers. So we think that these products by the other competitors would actually complement Adobe, that instead of like disrupt them fully, it would more like complement, as in, for example, Canva product, that the Adobe's customers could also use Canva products to complement their usage in their work on daily basis, not just really, because Adobe's product is much more complicated and much more varieties. They do illustration, not only Photoshop and video generating. I mean, most of this is just a bit simple compared to Adobe, right? And Adobe's customer is largely enterprises instead of just some retail customers. But then again, when it comes to stock market, right, it's more like valuation and analyst sentiment, right? They are not looking at this in the bright light that they think he is ready to shift and rotate to the other market outside of the creative industries instead of just, why are we holding this instead of when we have, I think that when we have semiconductors, we have hyperscalers. So it's really, I think in a sense, the company is still holding, but when it comes to valuation and analyst sentiment, it's a bit weak. It's like, it's not just not meeting their expectation. That's really about it, I think, about Adobe, right? That's really about it. So that's why you see the other segment like hyperscaler is growing well, AI like Palante is growing well. It's really about people are choosing on that, like people are rotating outside of the creative market instead of just holding on Adobe, right? Yeah. So I don't think that it's going up anytime soon. If you're looking for the share price, yeah, apologize for that. But looking at the fundamental, is I think much changes, just that the expectation is not met by from the investors' expectation. Yes. Thank you. Hope that answered the question.
Okay, thanks, Fahmi. I will take the TA questions. Yeah, so first one is on iFAST, Hong Kong Land and Q&M Dental. Yeah, so for iFAST, I think overall is still trending very very nicely. It just broke out of this $9.83 resistance level last week, forming an ascending triangle on the way. And also we had a build up over here as well at $9.65 resistance breakout. So I think we are likely to still see some upside again. I think in terms of the projected target, we could potentially look at using this height over here, maybe around 158, and then projecting it onto the 993 level. So that might bring us to target maybe somewhere close to 1140 about that eventually. So I think overall it's still trending very nicely for iFAST rate. And I expect the uptrend to continue. Next one for Hong Kong Land. Yeah, for Hong Kong Land, I think overall it's still on a strong uptrend, turning a bit sideways recently around this 812, this level over here. So I think most likely we could see some, for now, maybe some kind of sideways, but I think overall support will be around 786 if it does look to the level, a horizontal level, as well as a 10 SMA level. So maybe some sideways consolidation, but overall still a strong uptrend, and I think we could still see some high highs ahead. The next key resistance I think will be around 848. Yeah, around there. Yeah, the next one for Q&M then I think overall is still in an uptrend. It is trading in this uptrend channel generally. Since the retest of the 55-cent level, we've seen some pullback, but over January price has been pretty much kind of a bit sideways. So I think as long as it doesn't, I think there's likely to be some support at 51.5 cents. The swing low to about 52 cents is area this channel support. I think overall, as long as it does not fall below the 51.5 cents level, also around the 10 amps SMA, the weekly, which has been holding as a support, I think it should be still okay to carry on the uptrend. Yeah, but for now, maybe it looks like some sideways at this supports over here. Okay, next question. Can check Weher technical outlook at 90 cents. Okay, for Weher, I think overall it's still trending pretty strongly since the break of this ascending triangle over here. Last week kind of moved a bit sideways. You can see some temporary resistance around like about 92 cents this level. So I think for now maybe we would see a bit of possibly some sideways consolidation first as price actually touched the upper Bollinger Band, currently retreating a little bit. I think overall the uptrend is still intact for sure. Next support for now maybe around the lows on Wednesday's lower week around 87 cents, as well as maybe wait for the 10 SMA to catch up, which is currently about 85 cents about there. Yeah. So maybe we could be seeing something similar to this part over here. Previously, end of July, there was a bit of a dip towards the 10 SMA after a strong rally. And after that, we see another rally again. Yeah. So I think it's probably taking a bit of a breather after a strong rally for now week. But I think overall the bullish outlook in terms of technicals is still intact. Next question, can check Semco industry suddenly upward, any technical reasons? Okay, look at the chart. Yeah, for Senko industry, I think overall it has been pretty much range bound. So the good thing is that it has still held around this 596, this horizontal level over here. And then but generally has been still quite raised. Some resistance is the third time is testing it since mid-December is this $6.13 level. So there might be still be some resistance over here, but the good thing is that still we are seeing a bit of higher lows generally along the way. So I would think now support, if it does a pullback, I think maybe we'll find some support close to about slightly above $6. This SMEs over here, as well as the breakout of this range last week. Yeah, then next key resistance I think will be somewhere around 620 to about 626, this area. So I think for Senko industries, looking a bit better if we continue to form the higher lows and then multiple tests of resistance. But for now, still generally a bit more range bound with still some resistance above the current levels as well. Next question, for some power, what's the support and resistance? Yeah, for some power, I think generally it did a retest of this upward support line breakdown. So previously, I think it was a nice uptrend, but however, there was this gap down on 5th January, and then subsequently it did a retest over here around like the above 55 cents, and then made some resistance at 10 SMA, and currently is pulling back quite a bit. So I think for now, we probably will see maybe some close to this retest of 46.5 cents to 47 cents area, this swing low support as well as the horizontal level. I think we will see some bounce over here for this retest and maybe meet some resistance along the 5 SMA to 10 SMA area. Maybe I would guess somewhere around 51 cents to about 52 cents subsequently. Yeah. Then we might see some consolidate sideways movement afterwards. Yeah, below 47 cents, I think next levels are 43 cents over here. So I think that's for some power. Next one on CSE Global. Yeah, for CSE Global, I think overall it's still a strong uptrend. Price is on an uptrend. Recently broke out this $1.01 level, and then also did a bit of a consolidation over here, holding on the 5 SMA. So that's still positive, consolidating above the resistance breakout level. Yeah, currently just moving sideways again. So for now, I would think support probably around like 103, 104, this level over here, and around the 10 SMA as well. Then resistance is the highest last week, around 106. So it's just a bit of a sideways consolidation, I think, because it's quite near the upper Bollinger Band level. So we might see some sideways movement, but generally, I think overall uptrend is still intact. Yeah. Next one is on prop next. Yeah, for politics, I think a bit of a bounce recently, and then currently I think we'll see doing a bit of a some slight pullback as it nears the resistance since about 222 was a swing high, 223 I think was this previous breakdown level, this horizontal support. So I think for now maybe some sideways consolidation with some support likely be at 205 to about 209, this area over here. They swing low to the 10 SMA, then I think some slight resistance above 214, which was this breakdown of this swing low, and then the 5 SMA level. So we might see some sideways movement over there. And in terms of the weekly, I think retested the 20 SMA, currently might find some support along the weekly 5 to 10 SMAs level. So if it does a retest, so likely I think some sideways movement, I guess. Next question is on China Sunshine. Yeah, for China Sunshine overall, I think it's in a bit of a range with general resistance above 82 cents, and then the highest level was like 84.5 cents over here. I think for now there's some weakness because overall price was finding support at was finding resistance at 79 cents over here. Then there was breakout retest and then move higher, but since I think last Wednesday, I think since the pullback from 82 cents we've seen on Friday, there was a breakdown of this 20 SMA level as well as the 5 and 10 SMEs, as well as the 79 cents level. And then today went on down to about 76 cents. So I think overall this support at 74.5 cents to 76 and likely to still hold for now, but probably will find some resistance about 79 cents to about 80 and to about 80 cents for now. So some slight weakness coming in for now. We might see some a range between like 76 cents to about 80 cents consolidation at the lower area now, instead of the previous like 79 cents to 82 cents. Then there's a question on SIE engineering. Yeah, for SIE engineering, I think in terms of the share price movement, things it looks a bit weak for now in terms of the price action. Price broke below this 360 level over here, as well as the short-term SMEs. I think it might be forming a bit of a head and shoulders. So let me just draw that out. Yeah, over here. So I think the key level to watch is really maybe at this somewhere close to 338, this level, which has been holding as a swing low for 2 times since end of October. So we might see some bounce over here, but I think that we'll probably see a lower high resistance, maybe around 352 onwards over here. And subsequently, if it does break down 338, I think we might that might look at more down. That might mean more downside if there's a good part of this potential head and shoulders formation. So that's my take on the SI engineering. The next question is on China aviation. Yeah, for China aviation, I think overall it's generally still in an uptrend. Looks like it might be an uptrend channel, so I try to draw that out. So I think generally it might be trading within this uptrend channel. Recent price action, a bit of a slight pullback after it reached the upper Bollinger Band level. So I think we might see some slight pullback, the support around 172 perhaps, and around the 10 SME level over here. Then we might see some sideways, 172 to about 183 around there. But overall, it's still I think overall it's still a strong uptrend. And next one, Zixing. Yeah, for Zixing, I think overall, yeah, price has not done much in terms of the share price. Still quite a lot of resistance at the 0.039, and then price has been in a range for quite a long time. End of September, so generally just 0.033 to 0.039. So it looks like it's gonna continue over here for now. Yeah, and I would think some resistance is about for now it's at the 0.036 about there. And then if it breaks below 0.033, the next level of support may be at like also 0.03 to about there. If it does retest this upward support line along the way, which was formed since end of May 2024. So I think quite range bound for now for Zixing. The next one is the Lion OCBC Security APAC Financials Dividend Plus ETF. Yeah, so for this overall, I think it's in an uptrend, and recently still looks good. I think in terms of what, let me try to draw them. Yeah, so I see for this counter, the general support recently since like December of last year, I think general support has been around the 10 SMA level. So I think if it pulls back towards like somewhere around 133, 134, that will be the current support, and followed by next one is around like 131 over here. And yeah, and then but it's rather illiquid. I mean the volume is rather low, so that T might not be that accurate, but for now I think overall still in a strong uptrend, and support is probably 131, 133, 134 over here. Yeah. Okay, then next one is on some of the banking stocks, DBS, OCBC, and also I see a question on UOB as well. So I just go through all of them. First one for DBS, I think overall it's still been rather rather strong. Still, we had a higher new all-time high last Friday, and yeah, it looks like just trailing along the 5 SMA over here for now, 58.70 about that. I think following that, there's likely to be some support around for 58.30 as well, around the 10 SMA. So I think generally still trending along these 5 and 10 SMAs generally since mid of December. I think that will still be continue to be support. And resistance might be if it retest the upper Bollinger Band somewhere around there, which is like currently 59, 56 or what. So I think it's still on a very steady uptrend. Next one for OCBC, I think it's also on a very strong uptrend still. I think in terms of current resistance, maybe somewhere around $20.40, about $20.54, which was a high last week near the upper Bollinger Band currently. I think, but pullbacks, I think, if it does a pullback towards like $20.15 about there, there's a horizontal level as well as as a 10 SMA support as well. So generally still very strong trend for now. Yeah, then for UOB also playing a bit of a catch up for now. So it has been trending along the 5 SMA, this blue line, and also priced above this $36.12 horizontal resistance. So I think with that, likely we might still be able to see some upside if it tests the upper Bollinger Band, maybe somewhere around 30, close to 37 perhaps. Yeah. Then for now, the support is around the 5 SMA currently like 36.52. Then next one on Singtel. Yeah, for Singtel, I think in terms of the share price, it's been pulling back a bit recently. General resistance is finding along this trend line over here, and as well as a breakdown below this 455, this horizontal level. And short term wise, I think it might do a bit of a range. I think in terms of the downside, I think it's likely to be kept somewhere close to this 439 swing low. Overall, because there's also an upward support line over here, and also quite near the previous horizontal resistance, which is around $4.34 over here previously. So I think it's quite close to some key supports at the 430s region over here. So I'm expecting some sideways movement over here. Then there could be some recovery if it breaks above the 20 SMA, which is currently around 452, as well as the 455 is a key level. Yeah, so probably for now, maybe some sideways movement. Okay, next one, I'll go through, try to go through a few more, Prime US REIT. Yeah, so Prime, I think generally nothing too much. It's just a very has been just range consolidation since end of October, generally between 19.4 cents to 21 cents. So I think, yeah, nothing much to comment on this counter now. And then for iREIT, also nothing much generally, just also moving sideways. Which recently has been around between 20.5 cents to about 30 cents this area. Yeah. I has been forming like a bit of higher lows along the way. So if subsequently it does a few retests of this 30.5 cents level, then we might possibly see a breakout. If you can break above this resistance, then the next key resistance I think will be somewhere close to about 32 cents, about there. Yeah, so I think it's about one. I will just stop sharing my sharing over here. I think there's still quite a lot of questions. Unfortunately, I'm unable to answer all of them. But you can feel free to post them in the our Poems 3 community. Then I will take it over there. Yeah, I think I'll just stop sharing. So I'll just conclude today's session. Thanks everyone for all your questions and attending our webinar today. And I think this week we have the corporate webinar on Assembly Place. So if you're interested to find out more, feel free to dial in. And hope to see you all again in our future sessions as well. Yeah, thanks everyone, and have a good week ahead. Bye bye.